SEBI spent 18 months trying to cool India's derivative markets. Bigger lot sizes, fewer weekly expiries, higher taxes, more disclosure, literally using every rule in the playbook that they have. In Q3 of FY26, average daily options premium hit over 75,000 crores, higher than it actually was way before any of these curbs and rules came into place. This essentially is one of the biggest regulatory failures that has been seen in history. It actually tells you something important about the market that you're investing in. So between 2024 and 25, SEBI launched a comprehensive overhaul on India's F&O markets. Minimum lot sizes were actually tripled from 5-7 lakhs to 15 lakh rupees in notional value, essentially making every single options contract 3 times more expensive. Weekly expiries were restricted to just one per exchange. NSE kept Nifty 50 on Thursdays and BSE kept Sensex on Fridays, eliminating the daily expiry circle that had become enormously popular. Guys, the securities transaction tax was raised by approximately 60%. And SEBI required all brokers to display mandatory risk disclosures, showing exactly how many retail investors actually lost money. They did this because their own research proved that 91% of individual F&O traders were losing money in the F&O market, with cumulative retail losses hitting rupees 2.88 trillion in between 2024 and 25. Now understand why none of this worked and what is the structural paradox. Uncomfortable truth behind the numbers is this. The curbs, they did reduce trading for some time. Monthly options contract fell from 397 million in October 2024 to just 68 million by February 2025. Literally a collapse. By Q3 of FY26, premium turnover has not only recovered but surpassed pre-curb levels. Why, you ask? Because the larger lot sizes and restricted expiries did not remove the demand. They actually just filtered out the smaller retail players and concentrated actively on better capitalized traders and institutions, giving them an advantage altogether. They were then able to trade larger contracts. Understand that SEBI's own measures inadvertently made the surviving market more structurally concentrated. 20% of retail option traders who drive around 90% of F&O volume are firmly present in the market right now as well as per Kotak Institutional Equities. SEBI is still not done, and now this scrutinizer is actually planning to curb high-frequency trading, that is HFT trading activities on options, and is monitoring this closely, looking at modifying market-wide positions, whether to link position limits to actual delivery volumes. While Zerodha's volume crashed, Angel One lost 4.5 lakh active customers. Pro lost 6 lakh users. Brokers who are dependent on F&O for their business are now restructuring themselves towards margin trading facility loans, getting into advisory and consulting services, and portfolio products. The F&O market is still enormous, but the business model built around retail F&O is quietly under stress, even if the market refuses to slow down. You trade in F&O, understand that the market that you're in, the platform that you're on, are changing structurally and enormously, even if your trading screen looks the same. I hope you found this helpful. Follow for more.